When's the right time to file for Social Security? At age 62, 67, or 70? The answer could mean a difference of tens of thousands of dollars in lifetime benefits. Most people spend decades paying into the Social Security system. But when it's finally time to collect, they're not sure how or when to file, and that decision can make a big difference. Hi, I'm Mike Heatwole, founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. If you're planning to file for Social Security in the next few years, this video will show you how to make the most of your benefits, including the key filing strategies that most retirees overlook. One quick clarification before we start. This discussion focuses on Social Security retirement benefits. We're not covering disability benefits today. Those rules are more complex and beyond the scope of this session. Instead, our focus will be on how to optimize your retirement benefits and integrate them into your overall financial plan. Here's what we'll cover. First, we'll look at the current outlook for Social Security and who's eligible to receive retirement benefits. Next, I'll walk you through how to access your benefit statement online and what to look for when reviewing your estimates. Then, we'll dive into filing strategies for singles, couples, divorced individuals, and widows, followed by how pensions may impact your benefits. We'll also cover retroactive benefits, withdrawing benefits, and how earnings limits and taxes can affect your Social Security income. There's a lot to unpack today, so let's get started. Every year, the Social Security Trustees Report provides an update on the system's financial health. The most recent report projects that the Social Security Trust Fund will be depleted by around 2033. At that point, under current law, payroll taxes alone would cover about 77% of scheduled benefits, meaning a potential 23% reduction if Congress doesn't act. Now, depletion doesn't mean Social Security goes broke. It simply means that the trust fund reserves would be depleted and ongoing payroll taxes would continue to fund most benefits. Historically, Congress has always intervened before any benefit cuts have taken effect. What we don't know yet is how they'll act, whether that means raising the payroll tax cap, gradually increasing the full retirement age, or making other adjustments to keep the system solvent. Given the political reality, an immediate 23% cut to retiree benefits is highly unlikely. But it's still something we consider in every long-term retirement plan. Now that we've covered the system's outlook, let's look at who qualifies for benefits and how those benefits are calculated. So, who qualifies for Social Security retirement benefits? There are four main ways to qualify, one based on your own earnings and the other three based on someone else's record, like a spouse or an ex-spouse. To qualify based on your own record, you need 40 work credits. In 2026, you earn 1 credit for every $1,890 of wages up to 4 credits per year, which equals $7,560 in annual earnings. Once you've earned 40 credits, roughly 10 years of work, you're eligible for benefits. Your benefit is then calculated using your highest 35 years of earnings. If you have more than 35 years, only the top 35 count. If you have fewer, the missing years count as zeros, which can lower your benefit. As you continue working and replacing low earning or 0 years, your benefit will increase. Once you understand eligibility, the next step is to review your actual Social Security statement and make sure it's accurate. Now, you can review your benefit estimates by creating a My Social Security account at ssa.gov. Click Sign In the top right corner, and if you haven't registered before, it will walk you through the setup process. Once logged in, you'll see your Social Security statement, which shows your estimated benefits at different ages. The statement also includes an earnings assumption used in the projections. For example, it might assume you'll continue earning $60,000 per year until retirement. If you plan to stop working earlier, your benefit may be lower than the estimated amount. You can test this by using the Social Security calculators at ssa.gov/benefits/calculators to input your actual retirement age and income assumptions. Also, be sure to review your earnings record for accuracy. Social Security no longer lists all your annual earnings directly on the statement. You'll need to click Review Your Full Earnings Record within the online portal. Check for missing or incorrect years, especially those from recent years. If you find a 0 on your Social Security statement for a year when you know you worked, contact the Social Security Administration along with documentation such as a W-2 or tax return to correct the error. Now, I recommend reviewing your record every 2 to 3 years because correcting errors is much easier while records are recent. Now that you've confirmed your record, let's move into how your timing affects your benefits, starting with single individuals. If you file at age 62, your benefit is reduced by roughly 30%. If you wait until full retirement age, which is 67 for anyone born in 1960 or later, you'll receive your full benefit. And if you delay until age 70, your benefit grows by about 8% per year, which is a 24% increase overall. Here's a simple break-even example. If you start at 62 and receive $1,500 per month, by age 66, you will have collected a total of $72,000. If you wait until 66, your monthly benefit might be $2,000, but you'll have given up 4 years of payments. It takes about 12 years to age 78 for the higher benefit to catch up to what you missed by waiting. If you expect to live well into your 80s or 90s, waiting often pays off. Next, let's examine how these decisions unfold for married couples. When you're married, the strategy becomes a little more complex because both benefits interact. You can claim based on your own work record or on your spousal benefit, which equals half of your spouse's full retirement age benefit, not their delayed benefit. Let's use Tom and Mary as an example. Tom is 66 years old, and his full retirement benefit is $2,500 per month. Mary is 63, and her own benefit is $1,200 per month. When Mary reaches her full retirement age at 66, she'll be eligible for the higher of her own benefit, $1,200, or half of Tom's, $1,250. To qualify for spousal benefits, Tom must have already filed for his benefit. Now, if Tom delays until age 70, his benefit will increase to about $3,300 per month. Mary's spousal benefit, though, will still be based on Tom's $2,500 full retirement age benefit, not the delayed amount. That's a common misunderstanding. However, when Tom passes away, Mary's survivor benefit will step up to Tom's higher delayed amount, $3,300 per month. That's why delaying the higher earner's benefit can be one of the best longevity planning tools available to couples. Now, what if either spouse files early? Let's look at Tom filing early at age 62. His $2,500 benefit would drop to about $1,825 per month. If Mary waits until her full retirement age, she can still receive $1,250, which is half of Tom's full retirement amount. But if Mary also files early at 63, her benefit will be permanently reduced to about $1,025 per month. That reduction lasts for life. These early filing reductions cannot be undone, which is why timing decisions deserve a closer look. Now, let's talk about how similar rules apply to divorced individuals. If you're divorced, you may still be eligible for benefits based on your ex-spouse's record if you were married for at least 10 years, you're currently unmarried, and both you and your ex are age 62 or older. Your ex doesn't need to have filed for benefits. Social Security automatically uses their record. Your ex-spousal benefit equals up to half of your ex-spouse's full retirement age benefit. You'll receive whichever is higher, your own or theirs, but not both. If you file early, reductions will apply. If you wait past full retirement age, it won't grow further, so there's no reason to delay beyond full retirement age for ex-spousal benefits. Now, let's look at what happens when a spouse or ex-spouse passes away. If your spouse or qualifying ex-spouse passes away, you may be eligible for survivor benefits. You'll receive whichever is higher, your own benefit or your late spouse's. Now, you can start as early as age 60, but benefits are reduced if you take them before full retirement age. If you're still working and you earn above the 2026 earnings limit of $24,480, your survivor benefits may be temporarily reduced. Waiting until full retirement age ensures you receive the full survivor amount. A unique feature of survivor benefits is flexibility. You can take a reduced survivor benefit at 60 and switch to your own higher benefit at 70, or you can do the reverse. Next, let's cover one of the biggest policy updates that took effect recently, the repeal of WEP and GPO. As of January 5, 2025, the windfall elimination provision and government pension offset have been repealed. This means your Social Security benefits are no longer reduced if you also receive a public pension. The law is retroactive to January 2024, so if your benefit was reduced or if you never filed for your spousal or survivor benefits due to these provisions, contact the Social Security Administration. You may be entitled to an increase or even back pay. Next, let's discuss retroactive benefits and withdrawing a previously submitted application for benefits. If you delay filing past your full retirement age, you can retroactively claim up to 6 months of benefits as a lump sum. For example, if your benefit at full retirement age is $2,500, but 6 months earlier it would have been $2,400, you could choose a lump sum of $14,400 and then receive $2,400 per month going forward. This can be useful if circumstances change, like a health diagnosis or unexpected job loss. On the flip side, you can also withdraw an application that was previously submitted within the past 12 months. To do so, you must inform Social Security and pay back the gross amount paid to you from your benefit start date. You can only do this once in your lifetime. Next, let's talk about something that affects every retiree: the annual cost of living adjustment. Social Security provides an annual cost of living adjustment, or COLA, based on inflation. In 2026, the COLA is 2.8%. It's applied automatically in January. This increase also applies to people who haven't filed yet. Your future benefit will reflect every COLA from age 62 onward. So, let's look at how continuing to work can impact your benefits. If you collect Social Security before full retirement age, and you keep working, the 2026 earnings limit is $24,480. For every $2 you earn above that limit, $1 of benefits is withheld. In the year you reach full retirement age, the limit rises to $65,160, and the withholding ratio improves $1 withheld for every $3 earned over the limit. After you reach full retirement age, there's no limit at all. Now that we have covered how benefits are calculated and the various Social Security filing strategies, let's discuss how your Social Security benefits will be taxed. Whether your benefits are federally taxable depends on your provisional income, which is calculated as half of your Social Security benefits plus your adjusted gross income plus any tax-exempt interest. If you're married filing jointly and your provisional income is below $32,000, your benefits will not be taxable. Between $32,000 and $44,000, up to 50% of your benefits will be taxable. Above $44,000, up to 85% of your benefits will be taxable. Now, if you're single, below $25,000, your benefits will not be taxable. Between $25,000 and $34,000, up to 50% of your benefits will be taxable. And above $34,000, up to 85% of your benefits will be taxable. Let's look at an example. Both couples require an annual income of $65,000. Couple 1 takes $25,000 from a traditional IRA. Couple 2 takes $25,000 from a Roth IRA. The first couple's provisional income is $56,000, meaning up to 85% of their benefits are taxable. The second couple's provisional income is $31,000, meaning their benefits are completely tax-free. At a 12% federal tax rate, that's about $2,200 saved per year, just by changing where the income comes from. Now, let's wrap up with how state taxes might affect your Social Security benefits. Many states, including Illinois, do not tax Social Security benefits. However, 8 states currently do: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Each uses its own formula, so check your state's Department of Revenue website for details. If you're within 5 years of retirement, this is the time to start coordinating your Social Security strategy with your tax plan. The timing of your filing can significantly impact your lifetime income, tax strategy, and survivor benefits. If you found this information helpful, please give us a thumbs up and don't forget to subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwole, founder and CEO of the Dala Group. If you are interested in seeing how we help our clients, visit us at www.thedalagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.